You've seen, the speed change, the size of the market change, maybe the size of the outcomes change. I just rattled off a whole bunch of things, but, and those are all my words. But I'm curious for your take on the 2 to 3 things that have changed the most over the last 20 years.
I mean, look, I think just the overall awareness of venture capital and entrepreneurship is just so much greater. I mean, there was no TechCrunch when I started and all that stuff. Like, there was no blogging. And so all of that stuff has just brought incredible awareness to entrepreneurship. Like, obviously, there's been amazing innovations like Y Combinator and people that can help entrepreneurs become more successful because they jumpstart them through, a bunch of lessons Leo learned and stuff. So there's been some amazing innovations in the space. But I'd say one of the biggest things that's different now is that companies stay private much longer. And so, the journey to build a business, it used to be a little bit in the early days, at least when I got involved in the business, it was a little bit of a sprint to get public as quickly as you could. And a lot of these companies were raising $35 million when they were going public, and they'd have a market cap of like $300 million or something like that. And, that would be the beginning of their public life. And then they would flourish as a public company and raise a secondary, grow. All those rounds now happen as private rounds, right? I think both the venture funds like Greycroft and many of the other top funds, as well as the big institutional investors in the public markets, realized, boy, there's a lot more alpha to gather and to kind of capture for our investors if we can stay investors in those companies as private companies longer, help them grow a lot faster through those adolescent years, or kind of really almost teenage years at that point, and take them public later when they're much bigger. And so as a result of that, a lot more capital is poured in. Funds like us have gotten bigger and raised growth funds. The big public hedge funds and even the investment firms like Fidelity have moved down and will now take big private positions prior to the public offerings. So that market's matured a lot and gotten bigger. But all of that, to me, means the most important thing for founders is that the investor relationship that you choose, right, especially early, but all along these private rounds, a lot of these people end up joining your board and play a massive role with you in whether they really are incredibly helpful or not into the future of the company, they're involved a lot with you along the way, time-wise, meetings, board meetings, all that stuff. And so what used to be maybe a 2 or 3 or 4 year journey from when most investors would get in until the successful ones went public, now it can be 10 plus years for our best companies. And we want the duration, right? We want it to go long. And so that, to me, puts the onus on the investor and the entrepreneur to spend more time together, understanding, is that relationship really going to be a reciprocally good one on a human level, besides just the terms of the deal and what have you. And I think that's a really underappreciated part of the business, and one that I focus a lot on, at least on my side.